everyone, my name is Kirk Reagan, and I'm here from High Flight Financial. And today I've got a very exciting topic, not only the Roth IRA, but the Mega Backdoor Roth IRA. Are you in a situation where you're out of the IRS limits, the contribution limits, where you can no longer contribute to your regular IRA, and then the regular 401k Roth IRA just isn't enough? Well, here I've got a topic today called the Mega Backdoor Roth. So what exactly is it? It is a way to get further dollars beyond your employee contributions to your Roth IRA. Beyond that, it's able to convert additional dollars into your Roth 401k. But how is this done? This is done by after you've taken all of your employee contributions into that Roth IRA, and then the employer adds their matching contributions. Then there's an additional dollar threshold there where this year in 2025, if you're under age 50, it's all the way up to 70,000, where you can make additional contributions that are non-deductible contributions. What does non-deductible mean? It means that you can't deduct it from your taxes. So you are going to pay the taxes on those dollars when they go in. Normally, this would not be a good deal for you. If you put those funds in there, you don't get to take the deduction. And then when you take it out, then you're taxed on it. That is not a good deal. But what you can do instead is you can make those non-deductible contributions and then immediately convert them into a Roth IRA, because you've already paid the taxes on those dollars. So you can do those conversions either into your Roth 401k and just do an in-plan conversion, or if your plan allows you, you may be able to do what's called an in-service distribution, where you basically take the money out. It would go into basically a rollover IRA, and then you would immediately do that Roth conversion on it. So what are the gotchas? Of course, there's going to be some gotchas on this. It's too good of a deal for there not to be some gotchas on here. So let me go over briefly what some of these are. The biggest one there is you can't have any money in a Trad IRA, a simple IRA, or a SEP IRA. If you do have funds in those, what it's going to do when you do your conversion is it's going to employ what's called the pro rata rule, where you're basically going to do a conversion. And if you've got $10,000 in a Trad IRA and you're doing $10,000 Roth conversion from these non-deductible contributions, well, half of it is going to be from the non-deductible and half of it is going to be from the Trad. So that you'll owe taxes on that conversion for your pro rata portion from the traditional IRA. So the best way to do this is to make sure that there are no funds in a traditional IRA, SEP IRA, and simple IRA. One of the easiest ways to fix that is if your 401k plan offers the ability to roll funds into the 401k, then what you can do is you can take that traditional IRA and roll those funds into your 401k, thus eliminating a traditional IRA and then opening up the option for this Mega Backdoor Roth. The next one is not all 401k plans allow them. Yes, unfortunately, not every plan is going to allow this, but most will. The next one is a big one. Don't overfund it. Don't put your employee contribution in there and then add on the non-deductible contributions to your limit of 70,000, because then there won't be any room for your employer contributions, your matching contributions. So if you max those out, let's say you try to put in, $10,000 a month every month, and that goes in, it knocks out your $23,500 first, and then it goes on to those non-deductible contributions. If you do that too quickly, you may miss out on those matching contributions later on. So keep that in mind. Make sure there's always enough room for your employee contributions. And that includes any matching contributions, any stock purchases that happen within your 401k, or any revenue sharing that happens in the 401k. Again, if those happen outside the 401k, that's okay. But if it's happening inside the 401k, you want to make sure that there's room for you to get all those dollars. Because if you don't do that, then the employer is just going to say, well, there's no room for it. I'm sorry, I can't give you those funds. All right. The next piece of it is if you go all Roth, if you do your primary into a Roth a 401k, and then you do these non-deductible contributions, it is likely going to increase your this year's tax bill. Now, there's plenty of advantages to doing this and why you would want to take those taxes up front. But keep in mind, if you're running on a monthly budget where you're basically making every dollar is accounted for, then that's something that you want to consider, because this will increase your tax bill in this year, especially if you're if you're putting all of your funds into a regular traditional 401k. Switching it over to the Roth 401k is now going to create all of those funds are now going to count as income for the year. The other thing is missed or late conversions. So a late conversion, what I mean by that is you've donated the funds in as non-deductible contributions. You've taken some time in between that and when you've actually done the Roth conversion. If your funds increase, well, then you're going to end up paying taxes on those increases when you go to do that conversion. And if it decreases, well, now you've contributed and you paid that tax on, but when you do the conversion, you've actually lost dollars in that. So that's one of the downfalls of it. The other piece is if you forget to do the conversion, well, then again, those funds are going to go tax deferred. When you go to take those funds out, the gains are going to be taxed at your income rates. So that's something to consider and to make sure that you don't miss or have any late conversions. All right, and why are we doing this? It's because there's contribution limits. So the contribution limits for 2025 are $7,000 if you're under 50 or $8,000 if you're over 50. Now, the 401k options, they're going to be much higher in there. They're going to be $23,500 or $31,000 if you're over 50. So those are the contribution limits. So that's what's holding us back, and that's why this Mega Backdoor Roth is such a great option. The other one is that the regular Roth IRA does have some income limits. So if you're over that phase out range of $230,000 to $240,000 for your modified adjusted gross income, then you're not going to be able to contribute to those Roth IRAs. All right, so here's a depiction of kind of what that barrel looks like. So again, if you're under 50, that's going to be a maximum of $70,000 total for the year. And if you're over 50, that's $77,500 because of your additional catch-up contribution. And yes, that additional catch-up contribution is not included in the 70, so it does raise it up to 77.5. And I've got an IRS link if you want to look that particular item up. In this barrel, you have at the bottom, you have your employee contributions. So that's your regular contributions that you make. The next is going to be your matches. There's also going to be revenue sharing and stock options if that happens to be part of your incentive package. But for most employees, that's just going to be the matching there. And then beyond that, you can make those non-deductible contributions all the way up to that $70,000 total limit. So that includes not only your contributions, the matching, and the non-deductible contribution. Here's an example of how those funds are distributed. So your employee contribution, if you're under 50, is $23,500. Let's say your employer matched $6,500. So that's going to be a total there of $30,000. So you have an additional $40,000 that you can contribute as a non-deductible contribution. Now, if you're over 50, the numbers are very similar, except for the fact that your employee contribution is now $31,000 because of that catch-up contribution. Your employer match is still $6,500, and you still have that $40,000 available to make those non-deductible contributions for a total of $77,500. And here's the IRS link that I was referring to. This kind of describes the limits and also the fact that the additional catch-up contribution is not included in that 70,000. Now this link here is only for the 2024 numbers. There unfortunately is not a 2025 link yet, but hopefully that'll be out soon. And now let's look at an example family and how this affects them. And later in this video, I'll show you a walkthrough on Right Capital about how I saved Mr. Fictitious Client, Mr. Roth, over $8.2 million over his lifetime by employing this Mega Backdoor strategy.
All right, so now we're going to go into our Right Capital planning software here, and we're going to take a look at an example client here. For this example, I named a client Mr. Backdoor Roth. And here's going to be a little look at his life here. So his net worth is going to be just shy of $232,000. He's got some small investments here. He's got developed his emergency fund here at roughly $79,000. And he's kind of started on his 401k here. He's got a Roth 401k investment going, so he's doing a good job with that. And then we're going to look at what he's got here. He's got a $560,000 mortgage at 6% 30-year term on his primary residence. And then if we look at his primary residence there, a house is $700,000. And the way that Right Capital software works is it does break out separately the expenses for your primary home. So things like the annual property tax, the annual insurance, and the annual maintenance, those are going to come out separately from his regular expenses. So when you see that, don't be alarmed at why his expenses might be lower than you may think. All right, now we're going to look at his goals. I try to keep this relatively simple for the sake of this argument here, and really just primarily showing the advantages of that Mega Backdoor Roth IRA. So looking at a retirement age of 65 years old, his retirement expenses, we're going to give him a little bit of a plus up. We'll see later that his normal expenses are at $10,000, but we're going to plus that up to $12,000 because he's going to want to travel a little bit more in his retirement. And then this is just the Right Capital's average planning cost here for health costs in retirement. When we look at his income, he's got a healthy salary here of $300,000, and we're going to grow that at 4% because he is in a successful career. So we're going to try to raise that above regular inflation rates. And then obviously we're going to end that income there at his retirement. All right, Social Security, we're just going to keep it estimated. To keep everything the same, we're just going to use this full retirement age. That may or may not be appropriate for this client, but just for the sake of this display here, we're going to keep that at full retirement age. All right, now we're going to look at savings. So I have all 4 accounts here that I want to look at through different iterations, and so we'll take a look at them right now. Right now in this default scenario, I have him maxing out a traditional 401k. We also have him adding $31,500 into the taxable. That's basically the amount that he would be contributing to those non-deductible contributions in order to kind of have a like-to-like comparison where they're actually investing the same amount of money. Here in the Roth 401k, we're going to have that contribution be $0 for the initial case, and same thing with the Mega Backdoor Roth IRA here. That's that after-tax contribution. And you can kind of see how that's done. Is we're going to convert that to a Roth 401k, and we're going to do it annually in that in-service withdrawal. Again, we're going to keep those at 0 for now. And just a quick look at his expenses. Again, like I said, we're going to use a simple approach, just a $10,000 of expenses, and Mr. Roth is still single. All right, so we're going to go ahead and look at the retirement section here. And as we can see right now, this current plan as we stand, and that includes this taxable savings as well. He is sitting at 70% with a median ending portfolio of roughly 9.5. But what I really wanted to point out in this first scenario is in this proposed plan, I looked at what if he just maxed out his 401k. So at $300,000 and as a single person, he's obviously not going to be eligible for that Roth IRA unless he had a ton of deductions, but we'll assume that he has the standard deduction in this case. And so he's not going to be eligible for that Roth IRA. So most people would just look at, all right, well, what retirement options do I have? Well, I only have my 401k. So if he just maxes out that 401k and does nothing else, so no taxable, nothing to those non-deductible contributions, so he's just maxing out that 401k and nothing else. We can see here that the median ending portfolio is $0 and he only has a 32% chance of being success. And this is the heart of the problem here with folks that make a lot of money. They're just not able to invest adequately in order to accommodate these higher expenses in retirement. All right, so at 32%. So how do we get Mr. Roth to have a successful retirement? Well, the first thing we can do is we could go back to that original scenario and plus up these non-taxable to that $31,500. If we refresh that, then we're going to be back to that 70%. So still an okay scenario. 70% is not a horrible number in this case scenario, but let's see if we can't do something better for Mr. Roth here. So let's instead, we're going to say, well, what if we just did the Roth 401k? So we're going to do the Roth 401k, and then we're going to do that taxable amount of $31,500. And we're going to see how that does. All right, so now we're up to 77% of probability of success, but we also see a large rise in that median ending portfolio. So now Mr. Roth's going to end up with about 14.5 million as opposed to 9.5 million. So more than a 50% increase. But let's see about that Mega Backdoor strategy. So again, with that Mega Backdoor Roth IRA, we're going to be doing those in-service conversions to that Roth IRA. All right, so let's go ahead and max that out. And now we'll, instead of doing the taxable, we'll basically do those non-deductible contributions here. So now let's refresh. And we went from 14.5 million to now 17.8 million and a 79% probability of success. So we can see that that is not quite double, but almost double by employing that Mega Backdoor strategy. And for those of you that want to see the details here, if we look at the cash flows, and then we go in and we look at how the additions are going. So in the current plan, again, what we're doing there is it's going to be the taxable of 31.5, and then that Roth you see is 38.5, and that is including the contributions from his employer. So his employer is contributing 5% here, so $15,000, and he is contributing $23,500. So a total of $70,000. And just so that you can see there, if we look over that span of, well, let's see, that's 11 years, he's going to be contributing $70,000 to $92,000. And in the proposed, again, this is the strategy with that Mega Backdoor Roth strategy here. So now that $15,000 is just the employer contributions going into that regular 401k. And then on the Roth side, now you're going to see not only the employee contributions, but also those Mega Backdoor contributions. And again, we can see that total is $70,000, and at the end, $92,000. So again, $92,000 for the proposed plan. In the current plan, we got $92,073. So a darn good apples to apples comparison. So if we go back to the analysis, again, I just want to reiterate how powerful that Mega Backdoor Roth strategy is. Without it, we saw that this Mr. Roth was not going to be able to save enough money with just using his 401k alone. And then if we added that taxable, we get him to a pretty good place, but we can do better. And how we did better is in that first step, we changed his regular contributions to that Roth 401k. That made a huge difference. And then converting, instead of doing the taxable contribution, doing those after-tax contributions. So again, as you can see from Mr. Roth's example here, he's much better off with these Mega Backdoor Roth IRAs. It really is a very powerful tool for a lot of people. Now, it's not going to be right for everybody. There's going to be different scenarios for different people based on risk tolerances and based on their own personal life experiences, whether they have upcoming expenses that are going to be more short-term versus those long-term retirements, if they need access to taxable accounts, if they want to retire early. All of those factors come into play. So I would encourage you to book an appointment with me today, and we can go through your exact scenario to see if this Mega Backdoor Roth would be suitable for you. And if you like this video, please subscribe to my channel, where I'll have more videos just like this in the future. And if you liked it, go ahead and give it a thumbs up. And if you've got any questions, please go ahead and throw those in the comments.
The information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should always consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential for loss of principal. Past performance is not indicative of any future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.